West Pacific Market Analytics with the West Pacific Week, and it's Glenn here. Sorry I'm a bit late this week. Had a really busy week past. Had some data issues with our routers in the neighborhood, and that stuff happens. It's just kind of a reminder that if ever the power goes out or we don't have internet, boy, is this world going to get crazy in a real hurry. I'll tell you, we are just so reliant on it now. But I wanted to come out and I want to do my bond market report here. There's something I want to talk about. This is the third in the series. We started out, and we're going to be revisiting all these reports in the future. I'm building these data models so we can watch the ongoing process. Of course, starting out with the FIRE, the FIRE, or the Finance, Insurance, Real Estate, and Energy, and then coming secondly out with the top four sectors within the S&P. And now I want to do this third segment, which I call the bond report, and I want to show you what I'm talking about here. There's three keys that are very vital right here in the bond report that are basically what this market is all about. And this bond market looks ready to uncork, and we'll hold a lot of the clues of what's going to happen ahead. Bonds are everything, 10 times the size of the stock market, and the Fed is really afraid of what could happen here. With the amount of debt we've got in the system right now, bond yields rising so high, and the massive amount of inflation we have just absolutely crushing the consumers, we're seeing the commercial real estate market completely implode. There's going to be cracks arriving. There's so much dead wood underneath the blanket, they're afraid to lift it up. Trust me, it's a mess out there. So we're going to take a look at that. We only care the data. Let's shut out the hype, all right? I'm tired of looking at all the hype I see on the internet backed up by no existing data models. They can make up whatever they want. They can put up what agenda they want. You know, even I was seeing from a reliable source that does CRE real estate on Twitter, he was showing a building, absolutely giant building on 34 acres that used to be the headquarters of a major sporting goods company, sold for $1.5 million. So, you know, there is no rebuild of America. That too is all a bunch of hype. There will be no onshoring of what is going to be the new America. It's just a pure hype play to keep this whole Ponzi alive. Listen to nothing, believe nothing. To me, the facts speak for themselves. You're not going to be selling a killer piece of real estate. I mean, we're talking just massive amounts of square footage that's sold for 1.5 million, as I say, on 34 acres out in Nebraska. It's just, you just don't see those kind of deals. We're just seeing incredibly cheap prices in the CRE commercial real estate market everywhere right now. It's an absolute mess out there. Pretty soon, too, we're going to see the cracks starting to appear in this absolutely overinflated housing market as well. Biggest bubble we're ever going to see in our lifetimes. So let's just tune into it all. Let's keep focused. The fourth in the series is going to be a commodity-based report that will be coming out in about a week, and that will cap off the two key reports that I want us to watch as we go forward into the future. Quickly, a disclaimer for West Pacific Market Analytics. Please, these charts are for educational and entertainment purposes only. Please do your own research. And, you know, always understand there's a lot of risk in this market right now and know what you're doing. So do your own homework, do your own due diligence, you know, use our data models to help you in taking a look at the bigger picture. But this is a very tricky market right now as we get into this extremely massive top ongoing in the market. And yes, it is a top. So let's get into some thoughts on this bond market model. I've shared a lot of member models on data here on this situation. We've got about an 85% retrace in the S&P. Again, you want to get a hold of me, destrytrading@gmail.com. You want to join the Discord membership. You'd like me to come on board and speak about any subject where I could bring some very good hardcore data models to the table to share with you and your members on a podcast presentation. So feel free to get a hold of me. Now let's get into it. Let's not waste too much time here. So let's jump straight into this report I put together here. We put them right here in our yield bond sector so the members can view these. And here is what I want to share with you. So let's go right up here to the start of it. And let's start right here with this. Now, this is where there is going to be a major problem here. We can see that starting in 2024, corporate debt maturing. So the three keys to corporate debt are leverage loans, high yield, and investment grade. We're going to look at that in just a moment. And you can see that when you're looking at the leveraged loan, the high yield, and the investment grade, that just in 2024, you can see this starting to heat up. You can see this year it's heating up even more. And you can see the amount of debt maturing means it needs to be rolled over, refinanced here with interest rates in the sky right now. And look at it, it gets even higher in 2026. In 2027, it's as high as now. It's at record highs in 2028, and it doesn't even begin to taper. And I wouldn't even call that tapering until 2030. I mean, we've got literally 1, 2, 3, 4, 6 years ahead, including this year, of just massive amounts of bond debt maturing. This is an ugly picture, folks. And this is very much going to play into the problems and the issues and the cracks that we're going to see appearing everywhere ahead. So that's the lead-off slide, is to understand this idea of all this corporate debt maturing and understand the 3 keys to corporate debt are these leveraged loans, these high yields, and investment grade. Now remember, the leveraged loans were part of what caused the market crash in 2007, and we didn't even have near the mess of what we do now. Of course, that was also the mortgage-backed securities, which are also a bond-based indicator. We're not looking at some of the outlying bonds in that area today. We're not looking at note yields. We're not looking at the Moonies. We're not looking at the tip-adjusted inflation type stuff. We're looking primarily just at the leveraged loans, high grade, and investment grade here in this report, because I want to focus on these 3 areas because these are key to what's going to be ongoing. So the first thing I want to start out with just a general bond market model here, and you can see all here of 2024, we've seen the literally seen the flows coming out to where we've got negative flows here. This looks very much like the flows we had back in 2022, but somehow it's all been able to stay elevated up here. You notice even the V channel here is collapsing. The flows are collapsing. This looks ready to uncork. This looks a bit dangerous up here. This is ready to have a disaster type move happen. And actually with the tail risk model that I've been sharing, there's a lot of risk out there, and it shows in the tail risk model. So, you know, I think the bonds is where we're going to see a hiccup ahead. And so here's another general bond model. You can see that the mock portion here has still been rising. So of course you can see out of this low here, this is where the bonds had a big rally. In all these models, the red is the markets. I just wanted to put them in as a trailer because you can see how important the bonds are to the overall markets. You notice here in 2022 when we had the bond market flush, we had the market flush 2020, but that was a different situation because look at this huge rising V channel here. And then notice here, once we came off the top, we priced here into the V channel, and now the V channel is down here. So we need to come from here down here back into the V channel. There's a big drop setting up here. So the whole complex looks very ugly. We got a triple top right here, 1, 2, 3 already in. We've got the trend below. We've got the V channel below. The bonds are not pretty looking. Now, how fast is it going to take? Well, that we're going to have to watch. Now, let's start off with the investment grade. The investment grade we can see at the lows here. You notice at the lows testing near to the near to the gate here. You notice there was our low in the market here. You notice here, there was our low in the market here. So we can see investment grade is very, very key to the market. So, when you're looking at these various areas of bonds, most of this being corporate based, there's a boatload of debt out there and a lot of it hidden, through the derivative structures and other things like that. And you can see that the market is priced well above. You can see the trend is trading flat here. There's been no rebuild back up in the trend here. And again, you can see the look is just not bullish there in the investment grade big picture. And you can see it here in this investment grade. Look, you notice how up here you had the V channel up here. You notice here in red, the investment grades after 2020, they had to rally back up because the V channel was up here. Okay, you see that? So we had to rally out of that 2020 low. And then you notice in 2022, we got the bear cross here, the V forming below. You see it here, it got too low. It came back up to the dot curve, and then it broke out. But the V is now collapsed even more. The dot curve, or this whole thing, the V channel, remember, is a momentum-based channel. So momentum is continuing to drain. It's kind of flatlining here, but man, you cannot price the markets up here. This is just getting ready, you can see here, to roll over. If you want to, you could almost call it a nice-looking head formation here, a left shoulder over here, this giant right right shoulder, left shoulder on the head complete. And then you could look at a giant, in a sense, right shoulder going on here, coming out, forming the head, left shoulder here, left shoulder on work now, ready to come down. It looks like the right shoulder of this right shoulder head and shoulders pattern is nearly complete. So I think we're going to see something really interesting shortly in the bond space. Now, I'm going to get into those models in a minute. You could see right here that in investment grade, the momentum is only now just topping out. So right here, you can see momentum in the curve topping out. The mock is still holding up above. It's fighting here. It's been fighting for about 2 months here. You notice that initial sell-off, and the bonds here in red were holding up. The investment grade, they weren't able to sell off. They came back up. We're priced right here, right now in red. And it just looks ready all now to crack. It is not pretty looking here. Topping momentum here that's been building since the 2022 low. So we've got topping momentum in a lot of the bond sectors, and we can see it for sure there in investment grade. I put up a quick model here to show S&P and Fitch had downgraded. S&P downgraded American debt way back in 2011, and in 2023 Fitch joined the party. And this weekend we had Moody's downgrading U.S. credit. So I mean, there's some real issues under the cover. Everyone's now, all the rating industries have downgraded the situation in America. That is not a pretty picture. And here's another model of investment grade. We can see again the topping momentum happening right here at the end of May. That is not good. Topping momentum is completed. You notice how we've been shopping around here as this momentum's been completing. We've got the bear cross here. You notice starting to see some red down here. Look at the flows just selling off. People are using this as an opportunity to get out of bonds. I don't buy anything that is still being supported by the Fed. I think that's just a bunch of a sales thing. Now, when we get into high yield, we got the same picture. Momentum topped out here, actually back in 2023. You notice how it's just been grinding sideways, as I'm sure it's just been in a big distribution top here. Again, the same sort of formation, right? A giant head here, a right shoulder here. You notice here's a right shoulder, here's the head, here's the bounce back up for the right shoulder. I mean, we're not only seeing this AB formation or a topping right shoulder on the stock indexes, we're seeing the same sort of formation here within the bond complex. And this now all has to collapse back down to here. Okay, it's just going to take us back down to the 41 to 4600 area or maybe lower. Now to do that, we're going to have the gate open here below, but you can see you cannot price up here with the V channel below. So high yield also is at risk, and it is just not a great place to be right now. None of the bond sectors look pretty. You can see the ugliness everywhere. Now, when we look at the velocity model of the high yield, and we look at it at some of these others as well, you can notice here how we had the massive momentum top right here in 2021 and 22. And back here, you notice coming out of these lows, right? So coming out of these lows, we had to go back up to V. We come out of these lows, we had to go back up to V. We came out of this low, we had to come back over to V. Well, now we've got to come and collapse into the momentum channel. We've got a massive top in high yield. This has taken a number of years here to top out. So the bond sector has been topping out during the whole shenanigans that have been going on here out of the 2020 low and the money printing experience. So this is just not pretty, absolutely not pretty. You've got to be very, very careful being exposed to the bond sector. You notice again here, we've got the top out ongoing. Notice this big buildup here, and now the rollover in momentum starting to collapse here into June. And again, there's that bear cross, right? So high yield is showing a bearish setup. Again, we bounced back up here. Market got a bit too hot here. I don't expect this to hold. I'm thinking next week we're going to see a really good sell-off here in the markets. And the bonds, I think, are going to begin to start to work lower as well. Now, it could take a bit of time. We'll see what it takes, but we'll see it everywhere. Now we get into the leveraged loan. You know, leveraged loan bonds, as I mentioned here, were a significant contributor to the 2007 and 2008 banking crisis as their rapid growth, weak standards, and securitization magnified systemic risk. And I see this magnified systemic risk in the tail risk models. It's dangerous. It's really dangerous. And you know, they are not
the epicenter like the subprime mortgages, but they played a critical role in the broader financial meltdown. So you can see the leverage loans are really interesting because you can see they don't really sell off very often. And you notice only when they sell off does the market sell off. But notice the V channel is down here. And, this is going to be a very good indicator of trouble ahead is once we see a breakdown in the leverage loan area. You can see here, again, the V channel below, momentum top back here in 2022. I think smart players have been offloading the bonds as fast as they can because this is just not able to price up here. This is extremely overpriced and is eventually going to need to break down here into the V channel this year. It's coming. It's ripe as ripe can be. And you can see it here. You notice the velocity rolling down. It's trying to come back up. We had a big rally out back up on the leverage loans to actually a new high. Incredible. They just don't want to let it go. They're just, I think, so fearful of all the debt out there, they don't want to let it go. And notice the signal focused right up top here. I'm going to watch for this signal to turn down. But look at the red coming in here in 2025. This is selling. So coming out of that low, when I feel the Fed bailed the bond market out at that low in October of 2023, which was a big part of this rally, either that or it was just simply the pattern of a technical move. And I favor that more. But this is, look, we were over here pricing back here. Now we're pricing up here. This is just absolute lunacy to see the bond market pricing at these levels. This is an interesting model on the option spread within the bond sector. And what's so interesting is you notice right at the market low here, that is where the option spread topped out. And then as it's come back down on the option spread of the bonds, the market has been able to rise. So I want to be watching this particular model. This is something I've shared with my members. I'll give you a bigger picture look at it. Did I put that here? I think I had a bigger picture of that one. No, actually I did. I put that in the slide presentation, a much larger picture of this option spread model that's really interesting. So you can take a look at it in the slide presentation that will be accompanied with this video as well. And again, the Fed tool model here, the Fed tool, remember, and I put that in the slide presentation as well, the Fed does have a right to buy bonds, and they use the bonds for sure to support the markets. They don't have in their mandate the right to buy stocks, but, then again, I think through BlackRock and some of their large intermediaries, they're probably buying stocks as well. Who's watching the hen house? We can't even get Fort Knox audited. So who's really watching what the Fed's buying and not buying? But I don't think it's going to matter. I think the Fed's got such a massively overinflated balance sheet. I think ahead at some point in the future, everybody says, oh, the Fed can't fail. Well, that's what everybody was saying about Fannie Mae and Freddie Mac, right? As the government took them over with over $5 trillion in debt, and they continue to exist as a government entity, and we don't even know what's going on over there as far as their bundling of housing loans into this just a gigantic out-of-control housing bubble where you don't have to be 58 years old to be a first-time home buyer. When are we going to get past this lunacy? Wake up! This is just absolutely the most craziest situation we've ever seen. And you can see here the Fed tool, what we're looking at, the Fed loves to buy TIPS inflation bonds to push the market up. And again, we got the same model. Look here, the head over here. Look at this nice head and this nice left shoulder here, and now heading down into a right shoulder looking formation on this entire pattern. So we're seeing this giant head and shoulders with the final right side now beginning to develop in the bond complex. I'm telling you what here, don't be fooled. Things are going to get really, really interesting. And we'll be bringing you all the data you need in the bond market. There's been a lot of talk about problems in the 30-year auction treasury market that the Fed's had to step in. They haven't been able to sell those really well. You don't know what to trust. And others are saying, no, the auctions were just fine. Everybody's still buying our debt. That's all fine. But, I only trust what I see in the models. And we've got models of the yields as well. We pretty much look at everything in the bond sector and keep an eye on it. And we're really now, with this new bond report I'm putting out to you, we're going to be keeping a close eye on the situation. I'll be back at you. Have a great week ahead. Thanks for tuning in. Hit that like, hit that subscribe, and I'll be back at you. Glenn out.